The mainstream financial news is telling you a story, it's a comforting one, about how the Federal Reserve is finally getting inflation under control. They're pointing to the rate cuts of 2025 as a victory lap. But what if that story isn't the whole truth? What if it's a misdirection, designed to make you look one way while something much more important is happening behind the curtain? Because while everyone was celebrating lower rates, the Fed quietly opened a back door to the financial system. They've flipped a switch, unleashing a wave of liquidity that looks set to crash into the economy in 2026. This isn't just a theory. The data is hiding in plain sight on the Fed's own balance sheet. In this video, I'm going to show you the charts they hope you'll ignore. I'll expose the mechanism they're using for a new kind of stealth money printing and explain exactly how their actions in 2025 have set the stage for a vicious return of inflation in 2026 that could devalue every dollar you've worked so hard to save. First, you have to understand the official story. It's the one you hear from talking heads on TV. According to them, the Fed spent the last few years fighting to slay the dragon of inflation. Their main weapon, of course, was jacking up interest rates at the fastest pace in decades. The goal was to deliberately slow the economy and cool down runaway prices. And according to the official narrative, it worked. So much so that in 2025, they started to ease off. The Federal Reserve cut interest rates 3 consecutive times, bringing the benchmark federal funds rate down to a range of 3.5% to 3.75%. The justification was simple and reassuring. The Fed told us that with the labor market finally cooling off, they could afford to ease up a bit. They acknowledged that inflation was still, in their words, somewhat elevated, but they assured us it was on a clear path back to their 2% target. It all sounds perfectly reasonable, right? Responsible, even. To sell this story of cautious management, they point us to the dot plot. This is where Fed governors anonymously map out where they think rates should go. If you look at the current dot plot, the plan shows maybe one more small cut next year. The message is clear. We've done the hard part. Now we'll be patient and guide the economy to a soft landing. This is the show. It's the performance for public consumption designed to make you feel like the experts are in control. But this is where the story they tell you ends and the reality begins. Because while they were directing your attention to the front door with these small rate cuts, they were quietly creating liquidity out the back. Now, we need to look at the part of the financial system they hope you find too complicated to bother with. We're talking about the repo market and two facilities that act as a hidden engine for the Fed's balance sheet. The first is the Overnight Reverse Repo Facility, or RRP. Think of it as a giant temporary vault for Wall Street spare cash. When money market funds were swimming in cash from previous stimulus, the Fed let them park it there overnight for a little bit of interest. In doing this, the Fed was pulling trillions of dollars of liquidity out of the financial system. At its peak in late 2022, there was over $2.5 trillion parked in this facility. That's $2.5 trillion that was not chasing goods and services and not fueling inflation. It was a form of passive tightening, helping the Fed by absorbing excess cash. Then a huge shift happened. Through 2024 and into 2025, that facility was systematically drained. That $2.5 trillion has been drawn down until its balance is now practically zero. So you have to ask yourself, where did all that money go? It didn't just disappear. That cash flowed back into the financial system. Much of it was used by market participants to buy up the high yielding treasury bills the government is issuing at a frantic pace. The effect of this drain is like a stealth liquidity injection of over $2 trillion happening at the exact same time the Fed was telling you they were fighting inflation. This brings us to the second piece of plumbing. What happens now that the RRP vault is empty? The Fed has already built the answer. It's called the Standing Repo Facility, or SRF. If the reverse repo was a vault for storing cash, the SRF is the Fed's permanent open for business cash window. It's a backstop where the Fed has promised that eligible banks needing cash can come, post their treasury bonds as collateral, and get all the overnight cash they need. While usage of the SRF has been minimal so far, the plumbing is in place to ensure cash is always available, especially if the government needs to borrow trillions and someone has to provide the liquidity. Do you see the trade they've made? They've swapped a temporary holding vault for a permanent cash spigot that can be turned on whenever the system needs it. This is the core of the issue. The draining of the reverse repo was the first wave of this backdoor liquidity. The existence of the Standing Repo Facility ensures the plumbing is in place for the next one. Now, this isn't quantitative easing by its textbook definition, but let me ask you, what is the functional difference between the Fed printing money to buy a bond and the Fed creating the plumbing to lend money against that same bond overnight every single night whenever needed? From a practical standpoint, it's a backdoor form of QE. It's a way to inject liquidity into the system without the scary headlines of QE5. It is, for all intents and purposes, stealth money printing. And the most dangerous part is the lag. It's a well established principle that monetary policy operates with long and variable lags, often cited as 12 to 18 months. This $2 trillion liquidity injection has been happening throughout 2024 and 2025. A 12 to 18-month lag puts us squarely in 2026. The cannon has been loaded and the fuse is lit. So, what does this all mean for you? For your family, your business, your future? It means the value of your dollar is facing a new threat that almost no one is talking about. Let's be clear. Inflation never truly went away. The war was never won. After falling from its peak, inflation has stalled out near 3%. That's still a full 50% above the Fed's 2% target. A 3% inflation reading means the cost of living is still rising painfully. It just isn't rising at the catastrophic 9% pace we saw before. The Fed acting as if the job is done while inflation is at 3% is like a doctor declaring a patient healthy because their fever dropped from 105 to 101. You're still sick. And now they seem to be pouring fuel on these smoldering embers. This brings us to the real reason why they might be doing this. The secret they'll never admit in a press conference. The US national debt is now over $38 trillion, and it's growing by $1 trillion every few months. The government has to borrow that money by issuing treasury bonds. Here is the trap they've built for themselves. If the Fed allowed interest rates to rise back to 5% or 6% and stay there, the interest payments on the national debt would spiral, consuming an ever larger chunk of the federal budget. The government simply can't afford a truly restrictive monetary policy for long. This forces the Fed to make a choice. Do they defend the currency or do they make sure the government can afford to spend? Their actions suggest they have already made their decision. They have chosen inflation. The rate cuts in 2025 weren't just about the job market. They were about preventing a funding crisis in the treasury market. It appears the Fed's true, unstated mandate is no longer just price stability, but also ensuring the government can continue its spending binge at affordable rates. We have seen this movie before. In the 1970s, Fed Chairman Arthur Burns faced rising inflation and a government that wanted low unemployment. He would raise rates, but as soon as the economy weakened, he would lose his nerve and cut rates prematurely. This stop-go policy led directly to a second, more powerful wave of inflation later on. We are arguably repeating a similar mistake today, only on a much grander scale. This creates the perfect storm for a new wave of inflation in 2026. The stealth liquidity from the RRP drain in 2024 and 2025 will have had 12 to 18 months to work its way through the economy. Just as the mainstream is celebrating a soft landing, this new money could collide with an economy where inflation never got back to target. While official projections show inflation gradually falling, the monetary policy lag makes a new inflationary impulse a very serious risk. So what can you do? The forces at play are enormous, but you are not powerless. The solution starts with understanding the real game being played. It starts with turning off the mainstream news and looking at the data yourself. The truth isn't in the press conferences. It's in the weekly balance sheet data from the St. Louis Fed. Watch the numbers, not their words. When you understand that a policy of stealth devaluation may be underway, your course of action becomes clearer. It forces you to question the wisdom of holding all your wealth in cash or in bonds that pay a negative real return after inflation. It forces you to look at real, tangible assets that can't be printed out of thin air. Assets like gold and silver have served as a store of value for thousands of years for this exact reason. Other hard assets, from productive real estate to other commodities, can also serve as a shield. Most importantly, the solution is to become financially educated. The system is designed to benefit those who understand it at the expense of those who don't. By watching videos like this and doing your own research, you are taking the single most important step in protecting yourself. If you want to stay ahead of the curve and get more insights into the real mechanics of the financial system, make sure you subscribe to this channel. The financial world is designed to be confusing, but understanding it is the key to preserving your wealth. So let's put it all together. The celebrated 2025 rate cuts were a smokescreen. The real story was the systematic drain of over $2 trillion from the reverse repo facility, a stealth liquidity injection that went almost entirely ignored. This, combined with the permanent liquidity backstop of the Standing Repo Facility, represents a profound hidden pivot in monetary policy. The potential outcome is that this wave of liquidity created in 2025 will crash into the economy in 2026. The monetary policy lag makes it a serious risk. The Federal Reserve, whether intentionally or not, is no longer just a guardian against inflation, it has become a potential engine of it. Through these backdoor operations, it is enabling the debasement of the US dollar to allow the government to continue its endless borrowing. They are, in effect, choosing to devalue your money. The only question is, will you let them?